Mortgage rates have dropped pretty sharply in the last several weeks, creating some opportunities for investors and for homebuyers that we haven't seen in months. But why did this happen, and will it last? Is this a good time for investors to jump into the market, or should they wait for rates to go even lower? Today, I'll give you the rundown on mortgage rates. Hey everyone, it's Dave here, investor, analyst, mortgage rate watcher. And I know the situation with mortgage rates right now is kind of confusing. It can feel like a roller coaster, but I really think I can help you make sense of it in the next couple of minutes. So stay tuned to watch this video. But before we get into that, the sponsor of today's video is longtime BiggerPockets contributor and America's top turnkey company, REI Nation. They have over 8,000 properties managed. They have 3,200 different investors they've worked with, and they have $2 billion in rental assets under management. As such, REI Nation stands as the leader in stress-free turnkey investments. They operate in 13 different markets, offering high-value properties with consistent returns and customer-focused property management services that outperform competition. So whether you're a seasoned investor or new to passive asset investing, REI Nation is ready to help you achieve your financial goals. They help mitigate risk, protect capital, and they deliver exceptional customer service. They've done it year after year effortlessly. So if you're ready to kickstart your turnkey investing journey, their website will be linked in our description so you can connect with one of their experienced portfolio advisors where your success is their commitment. So mortgage rates, what happened and why? We all know the Fed, they've been raising the federal funds rate, and this plus a bunch of other economic factors saw mortgage rates jump from the pandemic eras of 3s and 4% up to 7.5%. It was actually up that high as recently as April of 2024. But as of last week, mortgage rates actually dropped a full 1%, otherwise known as 100 basis points, down to 6.5%. And this happened for two basic reasons. First, the Fed has signaled very strongly that they're going to cut the federal funds rate in September. Now, the Fed doesn't control mortgage rates, they control the federal funds rate, but it sort of has this cascading effect that typically leads to mortgage rates going down when the Fed lowers their interest rate. And even though they haven't done that yet, the market reacts to what the Fed says they're going to do in the future. And the Fed has said that they're basically going to cut rates in September, so the market has reacted. The second thing that happened that really started to push down mortgage rates is the jobs numbers for July came out, and it was much weaker than expected. Unemployment previously had been at 4.1%, and it went up to 4.3%. Now, that may not sound like that big of a difference, and it's not a reason to panic yet, but weak jobs reports send off recession signals, and there is one called the SOM rule, which is a really reliable recession trigger, and that just started flashing after the last jobs report. The SOM rule basically looks at the rate of increase for the unemployment rate, and when it's going up quickly, there's a big risk of recession. That has happened. And the markets, not just the stock market, but the bond market too, got spooked. And that sort of pushed down mortgage rates. Because when there are fears of a recession like there are today, investors, generally speaking, they seek safety. They look for opportunities to protect their assets. And the safest thing that most people consider are US government bonds. And so when investors are looking to move their money to bonds, that creates more demand for bonds, and that drives down yields. It's a whole complicated topic into it itself, but basically when more people want bonds, the government doesn't have to offer as high of an interest rate to entice people to buy those bonds. And so bond yields go down, and that takes mortgage rates down with them. This has created the most affordable situation for buying a property in more than a year. And that's good news for investors. Of course, recession risk is not good for anyone. But if you're wondering, property prices have actually gone up in 4 out of the last 6 recessions. And although there is always risk of property prices declining, recession does not equal housing market correction. Of course, that's what happened during the great financial crisis, but it is not a one-to-one relationship. So if you're wondering if now is a good time to jump in, personally, I think the answer is yeah, it is. Because property prices have been pretty stable. They're actually gone up 5% year over year as of now, which is faster than they usually go up in a normal year. And although I think that growth rate is going to come down and we're going to see flatter prices, we actually haven't seen mortgage rates this low for a long time, and that makes the difference significant. So even if prices stay relatively flat, the difference if you, per se, bought a median price home right now, the difference between buying now versus a couple of months ago is $225 a month. That's really significant and going to make a big difference in the performance of any potential investment. Now, of course, you're probably rightfully wondering if rates are going to drop further and if you should wait until there are even lower mortgage rates. And the answer is obviously no one knows. But honestly, for me, I wouldn't count on it, at least for a while, and here's why. First, rates have already started to tick back up a little bit just since last week, just a tiny bit, but it shows that maybe the market's overcorrected a little bit. Second, if you're thinking, oh, when the Fed cuts rates, mortgage rates are going to go lower, unfortunately, that's not really how it works. The market prices in future Fed moves. So they're not waiting around for the Fed to cut rates for everything to react. They've already reacted to the probable September rate cut. So we're already enjoying the benefits, the lower mortgage rates that are going to come from that September rate cut. So we'd actually need to see the Fed signal even more rate cuts for the market to price in a lower federal funds rate. Anyway, the last thing is that we're, of course, in a pretty uncertain time economically. And that means that what the Fed is going to do is very, very unclear. They're definitely going to start looking to fight off rising unemployment, but at the same time, inflation is still too high. And this is sort of this inherent trade-off that the Fed is always trying to make. This is their job from Congress. They have to strike the right balance between economic growth, like low unemployment, and inflation. And so while recent data has pushed the markets to think that the Fed will pull back their combat unemployment lever, aka cutting rates, we can't forget that inflation is not defeated and they still have some incentive to keep rates high. Inflation is getting better, but it's still lingering. So it's pretty uncertain what the Fed is going to do. Yes, it is a pretty safe bet that they're going to cut rates in September, but what happens from there is what's uncertain. In my opinion, there is a chance that mortgage rates go lower in the next couple of months, but there is also equally good chance that they climb back up. I don't personally think they're going to get back into the mid sevens, but I think there's a decent chance that they climb back up throughout the rest of this year. Meaning, if you're interested in investing right now, you might want to take this opportunity to lock in a rate because the next few months, just no one knows. If you want to do that and lock in a rate, there are plenty of good lenders you can do that. You can go to BiggerPockets.com/lenders. You can get matched with an investor-friendly lender today. They can help you figure out if right now is the best time to lock. I'm not a lender. I'm just an analyst. And speaking of analysts, for the record, most other analysts, people who work at big banks and financial institutions, also think that rates are going to stay around where they are, if not be a little bit higher through the rest of the year. And so take that for what you will. Again, no one knows for certain, but waiting around thinking mortgage rates are definitely going to go down over the next few months is not necessarily true. So you should at least talk to a lender and see if right now would be a good time to lock in. That's what we have for you today, everyone. Hopefully this makes sense and makes you understand at least a little bit better what's going on with the roller coaster of mortgage rates. For BiggerPockets, I'm Dave Meyer. See you soon.